I am so excited to welcome back Micheal Oliver, the godfather of momentum structural analysis, which has helped investors track these trends in the markets. And the last time we talked, a lot of what he said came true. So welcome back, Micheal.
Good to be back, Elliot. Thank you.
Yeah, great. Thanks so much. So the first kind of thing I wanted to talk about was the stock market, because last time we talked, you said we're near a top. And if the S&P 500 corrects 10%, which I think you were saying since we're near a top, it probably was going to, then it's going to be kind of crisis time and a lot of momentum structures are going to break. So what is your model saying now?
Well, if you go back in time, even 100 years, let's say, the stock market or U.S. stock market measured by the Dow, and then in the 1950s came the S&P 500. Okay, we've gone back and you can see that over time, there are many boom bust cycles. Okay. We argue that those boom bust cycles are largely generated by monetary policy. The Fed was invented, came into being in the 1920s. Okay. And sure enough, it's created a lot of boom bust cycles with monetary policy helping to boost the stock market and certain other asset categories that they prefer. They don't prefer commodities, but it's okay if stocks get inflated. That's all right. Okay. We've never had a bubble of the quality that we have now. We've never had a bull market in 100 plus years that has gone up so parabolic, such a percent over so many years. We're talking a dozen plus years now since 2009 low. We all know that they invented the QEs and so forth, and a lot of policy nuances over that 12 years. And in fact, there's a good chart to look at that just sort of smacks you in the face. And the chart shows the S&P 500 over that period of time. And it also shows the Fed funds rate, the chart from the Federal Reserve of St. Louis, Fed funds rate. And what you can see there over many decades is a staircasing down with upward moves in rates and then drops. And so, but basically a downtrend in rates to the point where if you go back to 2009, you'll see that chart is basically laying at the zero line. It popped up to 2% and then went back down. But, basically you've got rate levels determined by a market intervener, not by market forces, but by a central bank that says, this is the price of money. Okay, well, it's free. Okay, money's free, basically. So asset managers and investors take that river flow and they put it where they want to. They're not under the whip of the Fed, but quite often, the Fed will come in at a low level in the stock market and start printing and lowering rates, and it will encourage investment in the stock market. That's their goal, after all. And so actually in 2009, the bottom week in March of 2009, we put out a report saying, okay, this is a major low. We had no idea, that it was going to go for 12 years at all. No fantasy on our part. But it was that time when that Fed funds rate got down effectively to zero and just laid there for 12 years. And so it's no surprise when you look at the S&P chart that it did what it did. But there's a point at which asset managers, Ray Dalio, for example, and there's others that have expressed caution and doubt about stock market valuations. And also the major issue underlying that is, like I think Dalio said, that don't just look at the price of your stock, look at the underlying value of your money unit, which is decaying. And there's another chart that goes along with that set of the Fed funds in the S&P, and that's the M2, money supply. And as you can see, it curves up and it's now gone vertical. But if you actually go back and you take that chart, which begins, I think, in 1959, and take every 10 years and just check where it was, it's basically 90% plus increase every decade. So let's call it almost a double in the number of money units out there every decade. Even though the chart curves up, it's still a doubling. But since February of 2020, the money supply has gone up about 42% in 2 years, way faster than the prior doubling every decade. So when you look back and you say, well, there's a commodity price inflation. What's causing that? Well, it's a supply problem, or it's Putin, no, look at the money supply chart. It went up 42%, So the CPI went up 7.9. It's hardly even keeping up with the money growth. Okay. So anyway, without academic argument set aside, but the point is that clearly monetary policy probably, and we think definitely, caused that S&P chart to go into curvature. Okay. Now, if asset managers, big asset managers around the globe, suddenly start to view via their own fundamental metrics, earnings and all these various things they want to look at, that this market, especially the US stock market, as opposed to the Japanese or the European, is parabolic, that it's a risk. It's too risky right now. It's too elevated. And they're not sure where it's going to go down, but they're likely to go down. So they're concerned. They need to move the money somewhere else or die. Okay. So clearly they've begun to move it. And in the fall of 2020, our measurements of the Bloomberg Commodity Index, plus analysis of each and every commodity within it, grains, copper, crude oil, so forth, were a coincident upturn in terms of our annual momentum analysis of each market. Not looking at the price chart, but looking at annual momentum and looking for what you call structures, meaning trend lines or ceilings on the momentum chart that were broken through. And it was amazing, the chorus that occurred basically around October of 2020, where so many markets at the same time, you would think, well, what does wheat fundamentals got to do with crude oil, right? Okay, or sugar or copper. Well, they all went up at once at the same time, which indicates to us that it was, in fact, assets moving into a low risk arena that had been depressed for 4 years, 2016 through 20. They were like a beach ball underwater. And the money was just starting to say, hey, we're going to go into a low risk, potentially higher reward sector asset category and exits some of our positions in the stock market, which makes sense. They also bought commodity related stocks. Oil stocks have gone ballistic. We call fertilizer stocks, which have gone, they're like tripled since late 2020. Certainly beat the stock market. And that's because of asset managers making that decision that, hey, I think, yeah, they provided liquidity, but I don't want my liquidity to go there. It's going into a lower risk category. And they've done well. And finally, the word gets around. One asset manager does it, the other says, I don't know. And then suddenly he sees the rewards being reaped by these guys that stepped out of the stock market, or to some extent. And now the crowd is getting bigger. There was another asset category that investors and asset managers tended to run to over the last couple of years. You can look at the coincidence of price behavior of the T-bonds, long-term government bonds, 10-year and 30-year. You can almost overlay it on a gold chart, which price of T-bonds exploded with gold, pulled back with gold, and so forth. And so it was evident to us that was also people escaping from what they perceived to be a higher risk category, the stock market, and putting it somewhere, a safe place. T-bonds were that category. However, that relationship now it's evident since late last year, has broken down, meaning T-bonds are no longer behaving positively on the upside in price, drop in yields, with upside in gold. The linkage is broken, which means that basically you've got one prime global asset and its related stocks, your gold, silver, and gold, silver miners, that no longer have the accompaniment of the safe alternative of T-bonds. They're the only one left. And so asset managers are focused. If you'll take a look at a chart, for example, it's stunning, of Barrick Gold, Toronto, we're in the US under GOLD, and Newmont, two of the biggest blue chip gold stocks in the world, and not where little speculators go and buy penny stocks and try to make, tenfold, but, where big asset managers say, I'm going to get into this category, but I got to buy into blue chips. I can't take the risk of buying into miners. If you look at their charts over the last month, they've gone vertical like a rocket ship. In fact, Newmont's in new highs. XAU index, which tends to be weighted, it's the oldest gold and silver mining index in the US, goes back to the 1970s. It's back to the highs, just like gold is. So it indicates to us that the asset reallocation out of the stock market into the other alternative, now one alternative as opposed to two, is the game. Now, we hear a lot of talk about commodities. This boom in commodities is going to end because it was temporarily, related to COVID, transportation problems, all these minor excuses. Nobody wants to blame the Fed. It's something else. Now it's Putin. Okay. And we agree. Putin to some extent will exacerbate the oil situation and speed it up, but it was already going to go where it was going to go. At $40, we turned bullish and we said it's probably going to 103 to 105. Well, we were wrong. It went to 130. Okay. Other commodities did similar type stunts on the upside. The problem is our analysis argues that it might end in temporarily here and there in this given market where you might hit it. Maybe the high in oil this past week at 130 was the high for a while. Okay, let's mark that down. Say, okay, that's true. You're not going to collapse. Our analysis of the major surges in these commodities is that the worst thing you're going to do is go into a plateau. Well, that's a problem because even if copper, wheat, soybeans waiting on fertilizer now, fertilizer is a problem, remember, okay, that could affect the world grain crops for the next year at least because of the uncertainty of the supply. Yes, you might stop a given commodity in its tracks, but you're not going to go back down to where you were. And even if the commodity surge just simply stalls for a while, and we're exempting gold out of this, by the way, it behaves differently from commodities. We'll point that out in a minute. It's going to cause a global recession. And therefore, that stock bubble that we've identified that has begun to break is going to have another excuse to break. And that is you're going to have high commodity prices, which cuts into corporate profits, et cetera, et cetera, et cetera, cuts into consumer demand, consumer spending, consumer debt, corporate debt, et cetera, et cetera. Highly likely we're going into a global recession. What does that do to the central banks? Do I need to answer the question? No. Okay. They can talk all they want to about we're going to raise rates, we're going to do this and that to fight inflation. But when their stock market, the corporate debt market, like ETFs like JNK, HYG, high yield corporate debt, meaning so-called junk corporate debt, and muni bonds, there's an ETF for that called MUB, they're in collapse mode, far more serious. In fact, they peaked like last summer and have been down. And they had been moving with the S&P, but they peaked months before the S&P did in late 2021. They peaked more like in the summer. And the Fed had outright bought those assets, those ETFs. They bought JNK, HYG, and muni bonds to help state and local governments pay their bills. But those markets, since they've sort of backed off, have now started to melt down. So add that to the mix of a broken stock market bubble, couple corporate debt, high yield corporate debt, and municipal bonds. Three categories they can't allow to go into disintegration. So this talk about policy shift, we'll see. But over the last 2 weeks, if you listen carefully to ex-Fed governors and current Fed governors, been chatting about, what we're going to do in March, okay, next week. There was talk about 0.5%. Remember that, a few weeks ago. Now suddenly, not going to be any more than quarter. Powell has assured us it's a quarter. Okay, fine. But the word caution has been in almost all their speeches, that we have to be cautious about what we do here to so-called fight the commodity inflation because there's certain other vulnerable categories. So they're aware of what's going on. Anyway, this paints the road for gold. And we think that the gold bull trend is the focal point. Now, I made a point a while ago about don't link gold necessarily to commodities. And it's pretty obvious. If you look at gold, it made a low in 2015, December of 2015, with low monthly close. It was 1,060. Okay. It jumped up, built a base well above the low between 2015 and 2019, and then in 2020 emerged from the base. And by summer of 2020, it had taken out the 2011 price high, which was just above 1900. It got up to 2070 in the summer, year and a half ago. Commodities didn't even turn up as a category until October of 2020. In other words, gold had already made its doubling in price from its 2015 low without the encouragement of so-called commodity price inflation. So don't be looking at the commodity category as an indicator for gold. Gold is smarter than that. It's usually ahead of commodities. So even if commodities do, each commodity peaks to some extent and then goes into a new high range of price action. That doesn't indicate to us that it's a risk for gold. Gold is looking at the central banks. It's looking at the ongoing decade by decade degradation in money units. So that's what we think investors need to think about right now, is focus on that big picture.
Yeah, no, it's all laid out pretty clearly. So the fundamentals of the market, which is money printing and inflation in commodities, is lining up with your momentum indicators, which are showing multi-year and month breaks. And so it's all just lining up with your model. And so a lot of people, the narrative is that, I think a lot of people are still dip buying stocks because they haven't bought on to this whole trend shift away from stocks into commodities, right? So that could be another sentiment indicator that more people are going to get squeezed, maybe.
I think it's probably a good idea. We're not contrarians because sometimes being contrary is wrong. The mob is right for a while. You know what I mean? Yeah. But in this case, I think you're right. I think when you turn on CNBC, you don't hear, most of the comments are, when do we buy? Do we need another little flush before we buy? And is this overdone? They're all talking overdone. When do we buy? Not should we get out of this thing? Nobody's talking about that, or at least not many. And we think yes. Now, but we think the stock market decline will be a teaser because as most bear markets unfold in the stock market, just go back to 2000 top and look at week by week of the S&P to the 2002 low. Go back to the October 2007 peak and look how the action behaved to the March 2009 low. It was generally a layered arm wrestling decline where you would have teasing rallies that might even involve a month or two, where you gain 10, 15% and then lose 25 and gain another 10%, tease you all the way down until finally it just puked and was over with. So we expect that normal behavior, meaning don't expect to crash, expect instead an arduous arm wrestling decline where you're teased along the way. But as far as our metrics are concerned, you've broken so much stuff on annual momentum. When annual momentum, what do I mean by that? We measure price in its relationship to a annual moving average, like a 36-month average, which is like 3 year. Not against what's going to happen the next 2-3 weeks, but looking at the big picture. And so we get decadal moves on momentum. It would look different on a chart than that does the S&P price chart necessarily. The S&P price chart is such an upward curving thing, you could hardly even draw a trend line because its angle of ascent changes. Whereas on momentum, there's structure. You can see very clearly on the charts that, we just broke through a floor. Another floor. You don't see it on price. But we've concluded finally after the January action and then the February action that, okay, we have enough consensus. The market is topped. Now the only issue is the layered decline and the consequences that benefit gold due to what that decline in the stock market and muni bonds and corporate debt due to the central banks. It's that simple. But our favorite one, and I've made sort of an outlandish statement about this, that the next Bitcoin is silver. And what do I mean by that? Well, Bitcoin back in early 2020 went from $10,000 to $60-something thousand in 9 months. Ballistic. Okay. And now, it's down in the 30s and 40s again, pullback. Okay. Gold is now outperforming Bitcoin. That's a big issue because over several years, Bitcoin was, in fact, a better place to be from 2018 through 2021 early. It was a better place to be than gold. It was beating gold. It would have up waves, down waves, and so forth, but each zigzag would be better for Bitcoin than gold. That changed about 4 or 5 months ago. The spread difference between Bitcoin and gold shifted, broke trend, and we now argue that gold is outperforming Bitcoin. Well, sure enough, in the last 4 or 5 months, you can see it has. But underneath the gold umbrella is silver. And silver and the gold miners as well. I'll add the gold and silver miners to that group. We prefer to be in the miners and in silver than in gold. Though gold is the mama, it holds the leash, so to speak. But the yipping little dog is silver. Right. And silver looks like it's going to vastly outperform gold on a percentage basis over the next year or two. How vastly? If you go back 50 years and look at silver's ratio to gold, you'll find there were 4 times where the price of silver rose above 3% of the price of gold. In fact, 2 of the times it rose to like 4.5%, or one time to 6.5% price of gold. And then 2 other times just above 3%. Well, right now we're about 1.4% of the price of gold. If silver went to 3% of the price of gold, right now, just at 2000, assume gold stopped, okay, and silver went up and joined it at 3, it'd be $60 silver. Okay, our estimation is gold is probably going minimum, and I say minimum because I think we're in unusual times, $8,000 to $10,000.
Wow.
Now, that's not outlandish because there have been 3 bull markets in the last 45, 50 years in gold that have gone up 7 to 8-fold from the bear market low that preceded the bull market peak. Well, if you do a 7 times or 8 times the last bear market low, 1,060, you're talking $8,000 gold. Okay, so that would be nothing but replicating 3 prior bull markets in gold over the last 45, 50 years that have gone up that much in ratio terms. Well, if gold went to 8,000 and silver was at 3%, it'd be $240 silver. Almost 10 times where it is right now. So our indications are measuring silver's ratio to gold, that trend where silver has been underperforming gold all from the 2011 peak when silver was at $50 again through summer of 2020. Silver vastly underperformed gold. It was a far worse place to be. But since the upsurge in silver in the summer of 2020, when it shot up to 30 again, that broke that spread out into a positive trend. So we now think silver is in a positive trend versus gold. It was zigzag, but it's in a positive net trend. So our expectation is if gold goes to just a normal bull market high, again, 8-fold times the low, and silver goes just back to 3% again, which has been there, 4 times in the last 40 plus years and even higher, it could be in a couple $100 an ounce. And silver 3 weeks ago broke out over a major structure for us. We had quarterly momentum, which we measured silver in relation to a 3-quarter average, not a 3-year. And in the decline since the summer 2020 high, that trend was negative. Okay, but we built a base on quarterly momentum, and we went up through about 24.44 to put a precise number on it. 3 or 4 weeks ago, it broke out, and we've since shot up to about 27.30. And we think that emergence is indicative of the type of movement you're going to see out of silver going forward, mainly rapid and vertical. Wow. So enjoy. Don't wait too long.
No, and the physical supply is going to be pretty much evaporated at that point too. So the premiums on physical are going to be even higher, I'm sure.
I've heard that. Yeah.
Wow. So that is such an unbelievable scenario, because I'm trying to even think about like what the Federal Reserve can do, because are they just going to be watching the stock market crash, watching bonds crash, watching commodities spike? Like, what can they do?
We know the answer to that, but it's going to be a dance step for them, or how do they rephrase themselves without looking stupid? Okay, they went from easy to we're going to be tight, and then suddenly within months they're going to have to say, "Oh golly, we needed to be cautious, so we got to quit." Well, what are they going to say? They'll lose credibility. My bet is, and it doesn't matter to the markets, my bet is in the next couple of years, the Federal Reserve ceases to be. because it loses not only public confidence in its ability to determine events, which everybody says, you can't fight the Fed. That's a baloney. History has proved that many times. You can fight the Fed. When their bubbles break, you can fight them. They may fight the decline all the way down, but they won't stop it because asset managers shift the flow to some other place. And once this market is topped in most people's minds, and right now it has not. In our minds, it has. In the public minds and many asset managers, they still think, oh, no, this could be a buying opportunity. Once the realization is there that it's topped, the central banks, they have to shift again. And I don't know how they're going to do it, tell you the truth, without losing credibility. And if they lose credibility, they won't only lose it with investors, they'll lose it with academicians and economists. And if that ever occurs, the political consequences of that could be that we don't have central banks anymore, that we have enough governments, probably led by the Chinese of all people, go to a hard currency, a gold-backed currency, in which case you in effect circumvent the central banks because you back it with something that's fixed. I see that happening. That doesn't affect our market analysis. It's just, I think that could be a consequence, a political, social, economic consequence that you see in the next couple of years if this crisis goes to where we think it's going to go.
Yeah, that is just so big. And it plays into your bullish gold narrative of China and maybe Russia unite and do a hard currency, which actually, there's a report, I think, from Bank of America saying that the monetary order has changed and it's shifting kind of east. Yeah. And wow. So just thinking about that crisis that you're talking about, because it's actually a really, really big deal. Is there ever going to be a time where you see a buying opportunity in stocks again?
Oh, sure. I'm sure there will be. I mean, but a lot of events are going to happen. And I think this time, because of the nature of the bubble they created, its duration and its ascent, the percentage ascent, 12 years, that to the extent that was vastly overpriced of a major asset category, and it was, the unwinding usually does the opposite. In other words, it goes too far the other way. It overdoes it on the upside and it overpukes on the downside. So it won't be a reality-based low. It'll be overshot, but it should be devastating. And unfortunately, there will be social consequences, probably political consequences.
Big time.
And real world, in the street consequences. This is too big of a bubble to just sort of pass like some of the others have. So we remember 2008 and 2009 as disastrous, right? No. This one's far worse. It will be far worse. And you just got to be on the right side of the shifting masses here to do well during it and protect yourself.
Yeah, it's a collapse in the sovereign debt bubble, right?
Yep. And, pension funds, we're going to hear nightmare stories about that. Well, the central bank's going to have to come in and bail them out. Municipalities going to have to be bailed out. So the issue about do we print the money or not? Yes, they have to. That's what they were invented for, for the purpose of supporting that which government says you should support. Okay, primarily stock markets and categories that they deem to be more important than other categories. We don't care if the farmers get rich. Okay, we care if Wall Street gets rich. So anyway, but reality ultimately takes over, and reality is starting to take over.
Yeah, I just trying to think of the end game here. So they're rates have been negative for a while. So is there a way they could kind of say there's too much volatility out there? We're going to keep rates at zero, even though we have inflation at 9%. And then what does that mean?
I don't know if it means anything anymore, because ultimately, as we argued, that once asset managers, I'm talking big funds, billion-dollar funds, once they make the determination to move the investment capital they have out of one category to another, they don't flip a dime and do a change back the next week. It's generally glacial. And so once they've made that determination, and I think it's ongoing now, and again, look at a Newmont chart, look at a Barrick Gold chart, look what's happened to them. And remember, most gold mining investors have argued that, oh my gosh, if the stock market goes down, the gold miners will go down. We've argued that is a false notion based largely on one or two historical examples that were very brief and not really indicative of the trend relationship between the two. And that now look at gold miners since December and overlay it with the chart of the S&P since December and tell me that they're in sync. Okay. So once that shifts, the Fed could print all the money they want. They could do what all policy moves they want. That river flow they can increase the river flow again, but asset managers are going to push it in a different direction.
Wow. So every single possible indicator is pointing to your scenario you're laying out. You have the funds flows of the asset managers. You have the geopolitical turmoil, high inflation in commodities. You have the momentum structural model showing trend shifts. And it is still a contrarian trade right now. So it just seems like, seems very, very reasonable. Wow.
Well, there will be points where the stock market rallies. For example, we have a support level in the S&P we think is a bounce point, but it's at 3,800. Okay, so we're 4,200. Okay, 4,300. So we've only dropped halfway to that level. Well, if you go there, by the way, 3,800 is 20% off the high. So the idiot notion that once you're 20% off the high, a bear market can be declared, which is a stupid concept in the first place because it's arbitrary. Yeah. You'll be there. That's 20% off the high. So as soon as they start ringing the bell about, oh gosh, it's 20% off the high, it's now a bear. That's probably where you get your first rally. Okay, it's a bear rally, sell it. But we see potential for bounce points. Ignore them. They're bounce points. They're not trend changes. The trend is now up for commodities and gold, especially, and related, and down for equities.
Yeah, exactly. And so it'll be very interesting to see that bounce. It'll be this is obviously not investment advice, but just having the opportunity to buy some commodities cheap on that bounce could be life-changing potentially if all this plays out. I do have to ask you about Bitcoin because last time we talked, you nailed that so well. You said that I think it was 30K off of the 65K high. You said it's going to do a base pattern. It's not going to crash. It hasn't crashed. It's been kind of flat. So do you have any insight on that? Because that's a competitor to fiat. It's not a competitor to gold. It's a competitor.
Oh, yes, it is. And we, on a fundamental basis, we like Bitcoin. We like the notion of private money that is non-expandable. You can't infinitely expand Bitcoin supply in Ethereum. They don't go ballistic like the Federal Reserve can with the shaking of a pen or pulling of a lever. They can, right. Money supply goes up 42% since February of 2020. That doesn't happen. And therefore, yes, they're not backed by anything, but neither is the dollar or the euro or the yen. They're all pieces of paper issued by government.
Exactly.
But the cryptos aren't. They are limited in the potential supply. Therefore, they have that virtue. And as that notion spreads globally, and it spread globally more and more, it is in effect a subversive notion accepted by young investors that I don't need government money. I don't need your central bank. I've got Bitcoin. I've got, Ethereum, et cetera. So no wonder, and we predicted this over a year ago, the central banks will come down with jack boots on the crypto market. Not because it's a hiding place for crooked deals and stuff like that they want to blame it on, which is their typical rhetoric, or that they want to come out with their own cryptos, which of course will be inflation. Since they want to increase the supply of cryptos, they will. But that these private monies are competition to their control over money supply and the cost of money. They undercut the potency of central banks. And as these cryptos grow in acceptability around the world, from some single percent digit to double digit acceptance, triple, et cetera, all of a sudden the central banks are impotent if they allow this to happen. So they need to come down with jack boots on it. And it may be too late that they're trying to. So yes, we favor the cryptos, but right now our assessment is gold's a better place to be than Bitcoin. Though the ads we heard 3 months ago said the opposite, that Bitcoin is a better place than gold. The actual technical truth now is that gold is better than Bitcoin. Now, it doesn't mean that Bitcoin's got to go down. It just means it's going to perform less potently on the upside, probably over the next year or so, than will gold.
Wow. Okay. That is really good to know. Yeah. Because right now it seems the market doesn't understand it. So it's trading with the NASDAQ. But once they do realize it is a competitor to fiat and fiat collapses, it could actually do well.
Yes, absolutely.
So where can people go to stay on top of this in these turbulent times?
Well, our website is olivermsa.com, momentum structural analysis, olivermsa.com. We provide on the site, you can see some of our historical reports of the stock market from the mid 90s through 2011, I think, major tops and bottom calls. And information on our methodology. Why is our methodology different? What's the rationale for it? How does it work? So forth. And then you can request a sample. And we offer a Bitcoin subscription. We focus solely on that every 2 weeks. We offer a gold, silver mining subscription. And then we offer an all asset category subscription, which I heartily recommend, not because it's higher priced, but because frankly, you need to be aware of the major asset categories because they're bumping into each other. They're affecting each other. Stocks, bonds, currencies, and commodities.
This discussion is for informational purposes only. Please consult a certified financial planner when making any decisions about investing. And do your own research before making any decisions. Investments are risky, and you can lose lots of money in them.